This is the teacher Haris Pat and you are seeing my YouTube channel Learn Accounting with Sir Haris. Today we are going to solve from A2 Accounting. Today we are going to solve a question from A2 Accounting and the topic is accounting ratios. A2 Accounting and topic is accounting ratios. And this question has come in February, March 2532, just 1 month back, February, March 2532. And this is the last question of paper 3, February, March 2532 and last question of paper 3. First is basically from cash flow, then business purchase, and then we have a question of ratios. So let's start it. State 3 limitations of using ratios to evaluate the performance of a business. First limitation is this, that ratios are based on historic data, right? It is based on past data. So it does not tell anything about the future. It tells or predicts all the things which is based on the historic data. So it does not give us any information about the future. Second thing is this, that it talks about only financial data. Non-financial factors will not be taken into account, though they are also important. Only financial results can be compared and can be evaluated through ratios. Then different accounting procedures are adopted by different businesses, so their comparison becomes difficult. Although we are using ratio analysis to compare our business results with the competitors or with our previous year, but if we are going to compare it with competitors, so different accounting procedures can be adopted by different businesses, so comparison might become difficult. Then the size of the business and the location of the business also matters, because different sizes, if the business has two businesses have different sizes, they cannot be compared. And the location also matters too much. So size and location matters a lot. Then we can have, okay, so these are the basically limitations of ratio analysis, which I have given you. That location, size of the business, and the nature of the business. How can a business which is basically a shoe factory can be compared with a school? Not possible. So nature of the business also matters. It is a limitation of the ratio analysis, that two different nature of businesses cannot be compared. Let's move forward. Calculate to 2 decimal places the following ratios. Dividend yield ratio. So the first one which I'm going to solve is dividend yield ratio. Let's write the formula first, and then I will solve it for you. Dividend YIEL, dividend yield ratio. The formula is basically dividend per share over market price per share into 100. I think maybe I have taken the one is okay. So dividend per share over market price per share into 100. Market price per share is given in the question. You just see that it is market price per share is already given in the question. Let's see what is the market price per share. So the market price per share is 2.85. So the market price of one ordinary share is 2.85, and dividend per share we can calculate. How come, sir? Let's see. Okay, dividend per share, let's see. That is going to be amount of dividend divided by number of shares. Dividend per share is equal to amount of dividend, divided by number of shares. You will get the dividend per share. So let's calculate. First, let's see the number of shares. Amount of dividend is given. That is, dividend paid and proposed both will come. Okay. Dividend paid and proposed both will come, because we have to calculate the dividend per share now. And for that amount of dividend, we will calculate. It includes both dividend paid and proposed. So let's see. Dividend paid 2003 final dividend will be paid in the current year in 2024. Interim dividend is 35,000. And the 2024 proposed final dividend will be 10% higher than that of last year. So it will also come, right? Proposed dividend of the current year will also come, which is higher, 10% higher than the last year. So 60,000, 10% of 60,000 is 6,000. That is going to be 66,000. Now we can get the total of these. 60,000 plus 35,000 plus 66,000. That is the amount of dividend actually. 60,000 plus 35,000 and plus 66,000 divided by number of shares, which is 5 lakh. You will get the dividend per share. Let's see how I got the 5 lakh shares. It is given in the question. See, the ordinary share capital is $1 share and 5 lakh means 5 lakh divided by 1, so 5 lakh shares are given. So the total is going to be 161,000, means the amount of dividend is 161,000 divided by 5 lakh. We will get the dividend per share, and the amount of dividend per share is 0.322. Okay. Now let's calculate the dividend yield ratio, which is dividend per share, which we have calculated earlier, that is 0.322 divided by market price per share, which is 2.85 multiplied by 100. Let's calculate that. Let me check the market price per share once again, 2.85. So the answer for this is going to be 11.29 or 11.3 you can write here. So dividend per share or market price per share is equal to 11.3%. Right? It basically, dividend yield ratio basically tells you that how much dividend you are getting on each dollar invested in the market. So whatever investment you have made in the shares, by purchasing the shares from the market, you are getting that much 11.3% dividend on each dollar invested in the shares. Next ratio which we are going to calculate, let's move forward. The next ratio which is asked was, it is price earning ratio, and then there is gearing ratio. Let's do that. Price earning ratio, I'll write here. Price earning ratio, we have a formula. Market price per share over earning per share. Right? Price earning ratio, the formula is equal to market price per share over earning per share. So market price per share is 2.85, but earning per share we need to calculate. So let's calculate earning per share. That is going to be profit for the year divided by number of ordinary shares. Previously, the formula is profit after tax minus preference dividend. But now preference shares are not a part of your course. So the formula is going to be profit for the year divided by number of ordinary shares. Right? So let's see what is the profit for the year in the question. Profit is 190,000 and number of ordinary shares is 5 lakh. Same. So 190,000 divided by 5 lakh. We are going to get the earning per share, and that is going to be 0.197 divided by 5 lakh, 0.38. Now I can calculate the formula. Market price per share is 2.85 divided by earning per share 0.38. So we'll get the price earning ratio. That is going to be 7.5 times. Normal ratio, we believe that the price earning ratio should be around 10 to 15 times is considered good, but this is coming 7.5 times. Okay. Now the next formula is we have to calculate the gearing ratio. Formula for gearing ratio is equal to non-current liability or fixed cost capital over equity plus fixed cost capital. But the right is non-current liability, which because it is quite simple, equity plus non-current liability. That is rather more understandable and more easier to memorize, to remember. So let's see. In 200, sorry, because the answer will be in percentage. Either the business is highly geared or low geared. Non-current liability is 2 lakh. Over equity, we have 672,000 plus 2 lakh. So quite easy. 2 lakh non-current liability over equity plus non-current liability, 672,000 plus 2 lakh. So write it down. 2 lakh divided by equity 672,000 plus 2 lakh and multiplied by 100. So we'll get the answer of gearing ratio, which is going to be 22 point. क्या आती है जरा बताइएगा जी आंसर क्या आता है 22.435%. Can you calculate it for me? Okay. Next ratio which we are supposed to calculate is working capital cycle. Okay. Sir, how you know that? Let's see. Calculate the working capital cycle. Round up each component to the next whole day. आप उसको whole day में convert भी करना है. So let's calculate that. Working capital cycle. The formula for working capital cycle is inventory turnover in days plus trade receivable turnover in days minus trade payable turnover in days. Okay, so let's write the formula of inventory turnover in days. That is cost of sales divided by average inventory into number of days in a year, which is 365. Okay, plus trade receivable turnover in days is trade receivable over credit sale into number of days in a year, which is 365, minus trade payable turnover ratio. The formula for that is trade payable over credit purchases into number of days in a year, which is 365. So this is how we are going to calculate it. Let's put the values in the formula. Cost of sales. Let's see what is the cost of sales given in the question. Yes, it is given here. Cost of sales is going to be how much? 5,48,000. कर देते हैं 5,48,000 is the cost of sales. So I will write here 548,000 divided by average inventory. Average inventory is opening inventory plus closing inventory divided by 2. So opening inventory 56,000 plus closing inventory is 78,000 divided by 2. So opening inventory plus closing inventory divided by 2, and that is going to be the average inventory. So 56,000 plus 78,000 divided by 2 is going to be the 67,000. Now you have to remember this so that you must be very clear about this. That is why I have done it previously. It is different. The formula for inventory turnover in days is the same as inventory turnover, but you will reverse the formula actually. The formula will be reversed. Means average inventory over cost of sales. Average inventory over cost of sales, right, into number of days in a year, which is 365. Okay, average inventory over cost of sales into 365 plus. Always remember that don't do this mistake, because students used to do this mistake very often, that they write the formula inventory turnover in days, cost of sales divided by average inventory. No, average inventory over cost of sales into 365. So that is going to be 67,000, which is average inventory divided by 548,000 into 365 plus. Now trade receivable. Trade receivables, if given in the question, are how much? 1,10,000 divided by credit sale. If credit sale is not given, then revenue, whatever the sales is, we will treat it as credit sales. 1,10,000 divided by 9,88,000 Let me write it down. Divided by 988,000 into 365. Okay, we will calculate this. Then minus trade payable turnover ratio. The formula is trade payable over credit purchases. Trade payables are given, that is 54,500. Credit purchases 5,70,000. So we can do that. 54,500 divided by 5,70,000 into 365. Okay, now you can solve that. It's just a mere calculation. You can do that on your own. So inventory turnover in days, that is going to be 45 days, right? 44.645 it comes actually. But as it says that you have to go for the calculation to the nearest dollar, let me see to the next whole number, each component. Okay, that is going to be 45 days. Then trade receivable turnover ratio is going to be, that is 41 days. Okay, again I will convert it into the nearest whole number, though it comes 40 point something, 6 point something. Then trade payable turnover ratio is 34.899. So I will write it minus 35 days, 54,500 divided by 5,70,000 into 365. Right? Now, if I'm going to solve it, the answer will be 51 days. So this is going to be the answer, that our working capital cycle ratio is 51 days. Now, let's see. We are done with the calculation. Let's move back. What is more asked by the question? So X public limited company, a major competitor, has a shorter working capital cycle than B public limited company. Discuss the performance of B PLC in managing its working capital cycle as compared with X public PLC. So remember that working capital cycle, also known as cash cycle or cash conversion cycle, it tells the efficiency of the business, that how quickly they are able to, uh, you know, uh, retain its cash into the business. Because when you sell inventory, your cash is stuck in the business. Then you will sell it to the trade receivable. Trade receivable will give amount, which is the collection from customers, minus trade payable turnover ratio, the time we use to take to pay our trade payables. Working capital cycle is 51 days for B public limited company, which basically states that if we invest in our business, in our current assets, it will take 51 days to recover our amount back to us. Generally, it tells this thing. It shows the efficiency of the business, basically. So if X public limited company has a shorter working capital cycle, it means that they are managing their current assets more properly. It means that they are able to convert their inventory into sales quickly. They are able to collect amount from the trade receivables very quickly. Either they are giving cash discount to customers, or they are charging interest on overdue account, or they have a good relation with the customers. They are getting the amount quickly from in comparison to B public limited company, and they are making their payment to their trade payables at a later date. It means that they are making payment to their trade payables. They are taking longer time to pay their trade payables. That is why, because trade payables are subtracted from the working capital cycle, that's why they have a shorter working capital cycle. So they are enjoying a more better liquidity position, because they retain their cash quickly in comparison to B public limited company. So their working capital cycle is better than B public company, because shorter working capital cycle is always good for the business. So this is how you will discuss about. You can discuss about each component also, that we are able to, X limited company is able to collect amount from its customers quickly than B public limited company. They are making payment to trade payables, okay, at a later date in comparison to B public limited company. They are taking more time, or their suppliers are giving them more time to pay their trade payables. Next, X public limited also has a price earning ratio higher than B. Discuss the performance of B PLC as measured by its price earning ratio as compared with X public limited company. So let's see. I told you earlier that the price earning ratio, the formula is market price per share over earning per share. That is 7.5 times. That it means that the X has a higher price earning ratio. It means that X price earning ratio is better than B. Again, in the same as working capital cycle, B performance of X is better than B because the price earning ratio should be 10 to 15 times. It is 7.5 times over here. It means that people have more confidence in the business of X public limited company, right? So they will be more prone to purchase shares of X probability company because they will prefer X because they believe that the X probability limited company is going to be grow in the future and they will be have more capital profit. Their share price will increase more rapidly in comparison to B PLC. So better price earning ratio basically shows the investor confidence and growth of the business. So the price earning ratio of X public limited company is better than B public limited company, which is obviously the formula is market price per share over earning per share. It means that X public limited company has a higher market price and a lower price earning ratio and a lower earning per share. So it shows that the share price is growing in the market. So it shows that capital growth will be more in X public limited company in comparison to BPLs. So this is how we are done with this question of ratios. It's quite a simple and easier question. We did that. Okay. Now we'll move forward, inshallah. It might be possible I will not go for the tomorrow class. And then inshallah ta'ala, the next class we will move on Friday and we'll continue the concepts. Any problem? That's fine for today. Thank you very much.